What is going on, traders? As we continue to traverse through the terrains of the bear market, the number one question most people are probably asking is how long will the bear market last and when will my stocks recover? Well, it looks like things might have just progressively gotten worse last week. As you know, this environment is ever changing. We are getting new data points week in and week out. And if we care about our portfolios, it's important to keep our pulse on what is going on. Now, we have a new data point showcasing that how long the bear market lasts will highly depend on whether we hit a recession or not. You see, bear markets behave entirely differently during periods of recessions. Let's take a look at the last 11 bear markets, going from 2020 all the way back to right after World War II in 1946. You can see here that without a recession, the average bear market length is 6 months. That is after hitting a 20% decline or more. And the average length to recover is a little over a year at 13.5 months. Now, during a recession, a bear market is actually 3 times as long as it is without a recession. The average bear market length during a recession is 20 months. And the average length to recover is more than double what it is without a recession at around 28.2 months. Now, here's a little bit of a silver lining, and I'll talk about investments more towards the end of the video. But the average 12-month returns after the bear market ends, if we get a recession, is almost 50%, which makes sense because the drop is a lot more violent during a recession than without a recession. This is why it definitely pays to invest during a recession when most of retail traders and investors who are inexperienced are actually capitulating and selling their positions. That is when you want to be the ones buying their positions. And speaking of a recession, it looks more and more inevitable. There are 2 data points that are signaling the inevitability of a recession that came out last week, which we have to go over. And because of the high likelihood of an upcoming recession, and because of the data points that I just went over, showcasing how much your returns are if you actually invested in a recession after the bear market ends, we are definitely not rushing to buy things here. However, this is why we stay neutral on a day-to-day basis. And this is why we hedge our portfolios with things such as puts, because we actually do have options. You don't just have to sit on your hands and watch your portfolio bleed and try to decide on when to buy. You can actively bet against the market and hedge your portfolio by making back some money as your stocks continue to dwindle. This is something that we teach every day in our Elite Trading Academy. Our options day trade watch list is something that we send out every single day, showing you which puts we are buying if certain price levels are breached on certain stocks. You also get full access to all courses, current and future. The popular options course. We also have the day trading course that is dropping this week as of the time of this recording. You get access to that, the Zoom calls, the mastermind calls with me, where you get to ask me any question about the courses, and you get to chat with thousands of traders who are trading on a day-to-day basis. As you know, we just launched our new platform, and to keep this a tight-knit community, we closed the regular signups. However, you can click the link in the description below if you are interested in applying to join the Elite Traders Academy. All right, so a couple of data points and news stories that are pointing to the inevitability of a recession sooner rather than later is, of course, what's going on in the employment market. We went over tech unemployment and the fact that tech employment slowdowns are already here. And now we get a warning from Mark Zuckerberg, who says that the company faces one of the worst downturns that we've seen in recent history, which will necessitate a scaling back of hiring and allocation of resources. This guy even went on to say, I think some of you might decide that this place isn't for you and that self-selection is okay with me. Realistically, there are probably a bunch of people at the company who shouldn't be here. Now, already Meta or Facebook has posted 2 straight quarterly profit declines for the first time in a decade. And we just got a report that Tesla's April through June sales drop of 18% from the first 3 months of the year are well below the pace in last year's final quarter. Now, the reason I bring this up is because, as you know, in this channel, we've been tracking the unemployment rate. And usually when we hit peak unemployment and it starts ticking back up during an economic slowdown, that is when we see recessions. These gray bars here on the Fed unemployment chart, these are recessions, historical recessions going all the way back to after World War II. And you could see that most recessions came after there was peak unemployment for that period and unemployment started ticking up. So what we are looking for is the next round of unemployment numbers to see if we get an uptick in unemployment, because that, along with the inverted yield curve and some of the other factors we talked about, are signaling the inevitability of a recession coming sooner rather than later. And the next unemployment numbers come out July 8th, 2022 at 8:30 a.m. Eastern Time. Now, the second and more alarming signal is what just came out from the Atlanta Federal Reserve Bank. The Federal Reserve Bank of Atlanta's GDP Now tracker predicts that the second quarter GDP will contract by 1%, meaning negative 1%. As a matter of fact, it is tracking that we are already in a recession right now. Now, as you know, Q1 GDP came in negative, so this would signal a back-to-back negative GDP reading, which has signaled a recession every single time going back to World War II. Independently, Deutsche Bank's tracker is also showing the same thing, so the likelihood of a recession is pretty high according to some of the best indicators that we have currently. Now, the worst part about this is that the Fed is still quantitative tightening during this economic slowdown that we have. Obviously, something that they should have probably started when we had a strong economy coming out of the pandemic last year in 2021. Tightening during a major slowdown hasn't happened many times in history, and you have to go back to the late 70s, early 80s when Paul Volcker just went ham on the Fed funds rate and didn't care about what type of recession we'd get or what would happen to the stock market. Inflation was double digits and we needed to bring that down. And we plunged into a deep recession. So the only other time that we really have that relates to this or that compares to this, we've plunged into a deep recession. Now, price instability is still an issue. However, all signs are pointing to inflation actually peaking. This does not mean that inflation is going to go down. It just means that it might have hit a peak. How long that peak lasts is anybody's guess. However, if we take a look at the fixings market, and the fixings is a derivative that allows institutional investors to bet on the rate of inflation, you could see that they are betting that inflation will peak at around 9% for at least 4 straight months. So peaking doesn't necessarily mean that it's going to go down. It just means that it has hit a peak and they are expecting it to last at least 4 months. So the big question is then, which is the Fed more interested in tackling? Are they more interested in tackling inflation? Or now that a recession is inevitable, are they more interested in tackling a recession to try to ensure that a recession is more shallow than it is deep? My thought is that if we get back-to-back negative GDP quarters, then the Fed will actually start slowing down and put their foot on the brakes, especially if inflation data shows that it is peaking. However, the ironic thing is that the next FOMC meeting is July 26th and 27th, but the next GDP reading is July 28th. So the FOMC decision will come a day before the GDP reading. And if we look at some of the Fed's members' comments as well as the FOMC watch tool, you could see that a 75 basis point jumbo hike is still on the cards, is still in the cards for the July 26th and 27th FOMC meeting. And since that comes conveniently before the GDP reading of July 28th, I think this will be the last time that the Fed will raise rates aggressively before slowing down in September. And if we do get those back-to-back negative GDP readings, the question will be, how deep will the recession get? But as I said in the outset, when we finally do hit a recession, that is actually an opportunity to invest. And those of us that have had cash sitting on the sidelines will probably want to start deploying it here, as well as executing creative strategies like selling cash secured puts on stocks that we can potentially get for a lot cheaper than they are currently, or a lot cheaper than they will be during the time that the recession hits. And I will leave you with this last silver lining here, is that over a period of 10 years, if you invest in a stable and sensible portfolio that has a Sharpe ratio of 0.5 or greater, you have a 94% chance that that will beat sitting in cash. So again, as always, unless you have a retirement decision to make in the next couple of years, for most of you that have 10 years or longer in your investment horizon, recessions are a few in a lifetime opportunity to reshuffle your portfolio and get it right for the long term. Anyway, traders, hope you got something out of this video. If you did, go ahead and give it a thumbs up. Leave your comments down below. Let me know what you think of the inevitability of a recession, how you guys are investing during this time period or planning on investing. I love hearing from all of you. I try to respond to each and every comment. Subscribe to the channel, hit that notification bell. And if you guys are wondering where I am, I'm actually in New York for the next few weeks. So for those of you that are out here, feel free to hit me up on Instagram. We'll go grab a drink or something. Stay safe out there, traders. Peace.